We work with a lot of business owner clients, and one of the most consistent challenges that we hear them bringing up that they face is they know that there are opportunities for them to get more in the way of deductions. They just don't know what to do to take advantage of those. So, in today's video, we wanted to break down 10 easy ways for business owners to maximize their deductions. Welcome to Couple. My name is Michael Dunham, and with me today is Patrick Fontana, the founder of Fontana Financial Planning.
Welcome, Michael.
Cheers.
Cheers.
So, Patrick, to kick us off today, I'll turn it over to you for opportunity number one, which is hiring your kids. Something I know that you personally have done, and we recently did with my son Trip as well. So, at a high level, let's talk through what the benefits of hiring your kids can be tax-wise.
Absolutely. So if you're in the top tax bracket, for example, and in some states, California, if you throw on state income tax, some of those rates can be north of 50% that you're paying taxes on. If you have a eligible child that does some actual work like Trip, even though he's quite young, he's doing some modeling for us. He'll be on our website and be kind of featured, and he earned his first paycheck. So that took income from the top tax bracket to the 0% tax bracket. And that's going to be the goal, is anytime you can find that arbitrage between tax rates and do it legitimately, hiring children to do work, it works. And the other side benefit there is Trip now has earned income, so he can fund a Roth IRA for himself.
Making that tax-free income tax-free forever, as long as he doesn't touch it until 59 and a half, when he's allowed to take that money out tax-free.
Mm-hmm.
One thing I'll add too, just from a planning perspective, one thing to know is really the cutoff of tax-free income for your child is the standard deduction, which that goes up every year. So it's something to be aware of when it comes to the question of how much can I pay my child, knowing that, and then also knowing that they do have to do legitimate work. So you can't just pay them to do chores or pay them for no reason. They do need to do some sort of legitimate work to earn that paycheck as well.
Mm-hmm. Second item on the list, potential tax savings here for not claiming your kids as dependents. So there is a American Opportunities tax credit that sometimes makes sense and has a potential savings. Michael, if you could break down, when does this make sense? What's the income range and the savings?
Yeah, there's an income limit to be able to take the American Opportunities tax credit. So many business owners that are in a high tax bracket, in the top tax bracket, they make too much money to qualify. And that's where this opportunity comes, is if you do not claim your child as a dependent and they pay expenses for their education directly, $4,000 of expenses paid for by the child would equate to a $2,500 tax credit that they would be able to claim in the form of the American Opportunities tax credit. Now, it's a great idea to talk to your CPA about this. Make sure that there's no offsetting benefits that you'd be losing by not claiming them. But if you are in that range of having a child go off to college and in a high tax bracket, this may be an opportunity to get more money net into your family's pockets and less money going to the government.
Hey, Michael, one big terminology thing that I see happening a lot is when we say the term credit versus deduction. Can you break that down for us?
Absolutely. So a credit is more valuable than a deduction. And so what I mean by that, a credit is a dollar for dollar reduction in your tax bill. So a $2,500 credit means if you owed $5,000 in taxes, you now owe $2,500 in taxes.
So a credit is like real money, and a deduction is more, it's going to help me not pay as much taxes. But if you're in the top tax bracket, it's your tax bracket, 37%, or whatever tax bracket you have, that's where the deduction comes into play as far as how valuable it is.
Exactly. Yep. So let's move on to item number 3, renting your property for 14 days. And we have an article on this that we'll link to down below in the show notes. It's called the Augusta Rule. So it's inspired by the Masters Golf Tournament. That's where the name Augusta Rule comes from. What it allows for is it allows you to rent out a property for up to 14 days and pay no taxes on the income that you receive for renting out the property. And where this can get supercharged if you're a business owner is you can rent the property to your business for, say, a company retreat or a Christmas party or whatever it might be, you have to pay yourself a fair market rate for the use of your property, but you can rent out your property to your business for up to 14 days and pay no income taxes on the proceeds.
Home office. One of the most common deductions everyone can look at is if you have a home office and you have the ability to write some of that off. There are some limitations, but it's a smart thing to look at. Limitations are what, 300 square feet?
Yep, 300 square feet, $5 per square foot. And so the tax savings on that would be $1,500 times your tax rate, and that's the tax savings that would be provided by the home office deduction. Smart thing to make sure that you're taking advantage of.
Okay, charitable contributions. We as a firm have some big charitable goals and have looked at a lot of these angles as far as what are the smart ways to do it. Michael's got several blog posts and articles about charitable giving that make this a really powerful move. If you can use your business to do some marketing, which we have a lot of orthodontists and dentists and ourselves that do contributions to good causes that have some benefit, but it's marketing that runs through. From a charitable point of view, if you qualify, that is a smart way to do it. And you can give cash, you can run it through the business, you can use a donor advised funds. We've got a bunch of opportunities in that angle, but charitable contributions, rather than pay full income tax on your extra dollars, if you are charitably inclined, it's a smart thing to do.
All right, moving on to number 6, employing your spouse. And so the opportunity here is if you have a spouse that does not work, hiring them within the business. Again, they do have to do legitimate work to help out with the business, but hiring them within the business and paying them allows them to be able to make contributions to your company retirement plan. And so here in 2025, the limit for 401k contributions, if you're above the age of 50, is $31,000. So if you're a business owner above the age of 50 with a spouse above the age of 50, if you hire them and you pay them $31,000, that makes them eligible to be able to contribute that $31,000 to their 401k plan with your business, in addition to the contributions that you're able to make on your own. So it provides an opportunity to supercharge your retirement savings and get more money into either pre-tax or Roth 401k accounts for your family.
Definitely worth getting tax advice on how much to do, whether you can do it, whether you should do it if your spouse is already working, payroll taxes, some other things that come into play, what's the smart number to do. That's one of the things we look at with all of our business owner clients, is looking at what opportunities are out there to take advantage of. Next on the list, meal costs, which we have lunches and breakfasts and lots of client entertainment, client meetings. This used to be 100% write-off, but now it's 50% write-off. But definitely when you're having a legitimate business meeting or a team meeting or a in-office event of some sort, there's a write-off for meals.
Yeah, and one thing I'll bring up there is just the intentionality around who is a potential client of yours, right? Like it's easy when you're going out to lunch with somebody who is an existing client. I'll use our business, for example, financial planners. Theoretically, anybody is a prospective client of ours. And so anytime we go out to eat with another person, if we pay for that meal as a prospective client, that counts as a business meal that we can pay with the company card and write off 50% of the expense.
Yeah. One thing Michael mentioned there that I'd advise from a cash management point of view is to just be very disciplined with your cash management using the company card, right? We have a card that is specifically for that. We have a separate card that's for our charitable contributions and a separate card that's for the office kind of operations. And so you can do that same thing with your household, is have a card that is specific for each cause. And I'd advise that from a cash management point of view. Next on the list, a new car. The 179 deduction. I did this with a truck. One of the keys there is being over 6,000 pounds. I had a truck a few years ago that was a good tax write-off. And then now you can, with the new tax laws, take that depreciation 100% kind of upfront instead of 40%. The other thing with new cars, and we've been a lot of questions about this lately, we'll do a little follow-up answer, is on electric vehicles. There's some new news as far as the tax credits that's going to go away in, is it September?
Yes, at the end of September is when the electric vehicle tax credit, which is $7,500, and again, credit, which is better than a deduction, as long as you are below the income limits to be able to claim that tax credit. You have the ability to do that on qualifying cars up until the end of September. The one other thing I'll bring up with the Section 179 deduction. So, bonus depreciation is what Patrick referred to earlier. So, we have the ability to bonus depreciate 100% of the value of the car in year one. That's what came back with the passage of this latest tax bill. That is kind of impacted by the use percentage. So if you have a car that you use for business purposes, but also for personal purposes, let's say it's 60% business, 40% personal, you only get to deduct up to the 60% that's business. So there are some caveats and some nuances there, but bonus depreciation allows us to depreciate 100% of the eligible value in year one now. So next one on the list, Patrick, optimize your retirement plan.
So this one, I would say a lot of folks have retirement plans that they either started years ago and never revisited it, or worse yet, just don't have a plan at all. What we like to do is take the layout of the business, which we call the date of birth, date of hire, income. It's called a census, and essentially look at how can we individualize this plan for this particular business owner and reach their goals. How do we save the most money in taxes? How do we put away the most money for their future? And those numbers come about and the options come about by going through that process. You can put away a lot of money depending upon the structure and the income and really accomplish a lot of goals and save a lot of money in taxes. So optimizing your retirement plan is worth just having a deep dive on it. As we move to number 10, Michael, I'll pass back to you for HSAs.
Yeah. And so HSA, or health savings account, is a unique account type, which we have a video that we can link to in the show notes to go into detail around. But at a high level, the cool thing about an HSA, it's the only account type that's triple tax exempt, meaning you get a deduction for the money you put in. You get to take the money out for qualifying medical expenses tax free. And in the meantime, you can invest that money and it can grow tax deferred as well. So it's the only account type that has all three of those tax benefits. The caveat is you have to have what's called a high deductible health plan to qualify. And so a lot of our business owner clients, they set up their own insurance, or they do a PEO through their business, and they have different options, and they choose the high deductible plan, but they don't set up the HSA account. And so if you do have a high deductible health plan, it's a great opportunity. This year, you can, if you're under 55, you can put away $8,550 into an HSA. As a family, you get an additional $1,000 catch-up contribution once you reach age 55, which is unique versus most of the other catch-up contribution amounts. But it's a great way to put away money tax-free and then also receive Roth treatment on that money as long as you use it for medical expenses.
One thing I know Michael and I have both done is to invest our HSA and just essentially pay for, if you can afford to, pay for healthcare costs out of pocket. And then that HSA investment that you got a tax break for can grow tax free. And it's a way to kind of move towards endowing your healthcare. So it's excellent 10 moves to make. Let's say, close out our cup of bull with rebalance with discipline.
Cheers.